Hello. In this video, we'll continue with our gross income problem sets, and we'll focus on problem 10. Cantaloupe's employment contract calls for her employer to pay her federal and state income taxes on her $100,000 salary. So Cantaloupe is making a salary of $100,000, and the employer actually, in addition to paying Cantaloupe the $100,000 salary, actually pays Cantaloupe's state and federal taxes on that $100,000. The employer pays $40,000 for Cantaloupe's income taxes to those taxing authorities. So the idea here is, many of you that work out there that are watching this, you know that, okay, if you make a $100,000 salary, almost all employers don't pay your taxes, your income taxes. They pay a portion of your employment taxes, but when it comes to income taxes, they don't do that. So if you made a $100,000 salary, you're probably actually netting, you're actually going to get back probably $60,000 to $70,000 after all the taxes come out, and employment and income and whatnot, and also state income tax and federal. So you have to net out those things. Here though, this employer actually does cover the income tax portion. So Cantaloupe is getting a $100,000 salary, and then the employer is paying the $40,000 for the income taxes to those taxing authorities. So we're wondering here, again, this is a gross income question. Whenever we have a gross income question, the issue becomes, okay, we have 5 questions, if we have an income tax issue, we have 5 questions really to ask. The first is, do we have any income? What amount of income? The next is, what amount of deduction or credit? So the first is inflow, second is outflow. Then it's, when do we have income or deduction or credit? Who has income, deduction, or credit? And then the character. So we're focusing on gross income. So we're really looking at what amount of gross income, if any, when there's gross income, if any, and who has gross income, any. And if you're dealing with a gross income question, you should always focus on those items. Character is obviously important as well, but we're not really worried about that right now because we're dealing with just determining whether we actually have a gross income and whether it's included or not included or excluded. So we talked about that. And again, I just want to highlight what exactly is going on here. So Cantaloupe's employer pays $40,000 to these state, local, and federal authorities, to the authorities for Cantaloupe's taxes. For Cantaloupe's taxes. And the question becomes, that payment of the $40,000, is that gross income? Because if you look at gross income, which again under section 61 is defined very broadly, all income from whatever source derived, and then we go to Glenshaw Glass, which is a U.S. Supreme Court case, which says that gross income is an accession of wealth clearly realized in which the taxpayer has complete dominion and control. So the first thing there again is accession of wealth, which means net worth increases, which means assets minus your liabilities have gone up. Then we have a realization event, which we're talking about a severance, a legally severable event. And finally, the third aspect is you have to have dominion and control, which means there's no strings attached. And we're focusing on here the who. We're focusing on Cantaloupe because we're not focusing on the employer. The employer is paying out wages as well as the $40,000 of taxes. So we're looking at gross income, so we're only focused on the employee, Cantaloupe. And again, there's 2 real issues here. The $100,000 salary and the $40,000 of taxes. When we're dealing with the same tax year, so we don't have to really worry about that. It's all in the same tax year. That's the real question. And then again, that's what Glenshaw Glass defines, whether we have income, and if we do, what's the amount. So looking at the $100,000 salary, this is pretty clear. If we go through our analysis, have our assets gone up? Well, before the beginning of the year, we didn't have the salary. After, we do have salary. So we have cash. Cash has gone up. Boom, we have net worth increase. Realization. Well, there's services here. Cantaloupe's providing services. So therefore, we have realization. Services always equal severance and realization. Dominion control. Any strings attached to the $100,000 salary? No. So the $100,000 salary is included in Cantaloupe's gross income. Included gross income, the salary. What about the $40,000 in taxes? What about the $40,000 in taxes? So net worth. Has net worth gone up? Is there any asset here? Increase in asset? No, there's not. There's no cash or assets being received. It's actually going directly to the taxing authorities. So is Cantaloupe have any asset increase, which is an economic benefit? No. But what about liabilities? So you can think of your taxes as a liability because you're going to have to pay it. It's something that the government is a creditor. They get a portion of the amount you make in America. They get that portion. They have a right to that portion. That makes them a creditor, and therefore it's a liability. So actually, liabilities are decreasing, and when liabilities decrease, a negative of a decrease equals actually an overall increase, so there is net worth increase. So this $40,000 liability goes down. So if we have assets equal to before and after change, no change, before liabilities stay the same, but after they go down by 40,000, that means a negative of a negative 40,000 is a positive 40,000, so net worth goes up by 40,000. Realization, again, this comes from services. The employer is paying the taxes because of Cantaloupe's services, so therefore we have severance. What about dominion and control? So this is a huge issue. This is actually the main issue here because this is paid directly to the taxing authority. So can Cantaloupe do whatever he or she sees fit to do with the money? No, because it's going directly to the taxing authority, and Cantaloupe can't get that money, use it in whatever way. So dominion control here is an issue. It's an issue. So the question becomes, again though, she would have had to pay this anyways. She would have had to pay this. Dominion control does seem like an issue. At first blush, it does seem like an issue. However, we do have a case that addresses this. So a little history. We know the income tax in America came about in 1913, the one that we still have in place today, 1913. So a lot of employers were doing this because they were saying, hey, we can avoid the employee having to pay taxes on this $40,000 because we'll pay it and we'll get a deduction and the employee won't have to record it because of the dominion control issue, because it's not actually received by the employee. So there was a case in 1929 that said, no, that's too good to be true. And the name of the case is Old Colony Trust Company. And in that case, we had a very similar set of facts. We had an employee that received a salary and the employer paid all of the income taxes on that. And what we saw, and this was a Supreme Court case, and the Supreme Court said that this is gross income. It does not fail dominion control and does not fail the other elements, so therefore it is considered gross income, and therefore it is included in Cantaloupe's gross income. So the end result here is that both the $100,000 salary and the $40,000 of taxes that Cantaloupe's employer paid are included, so Cantaloupe has to include $140,000 in gross income with respect to this item. So the takeaway here is that if an employer pays income taxes on behalf of the employee and then they're paid directly to the taxing authority, those are included in gross income.